Want to welcome you once again to this advanced financial reporting lecture. We continue today to focus on non-current assets. My name is Ngandalo Joseph, and I thank you very much for taking some bit of time off your busy schedule to listen to this lecture. So I've got some questions with me here. Today we want to focus on impairment, just like the way we began last time. The Aston Company is testing for impairment two subsidiaries which have been identified as separate cash generating units. Some years ago, the Aston Group purchased 80% of D Company for 600,000. Fair value of the net assets of D Company then was 400,000. As D Company's policy is to distribute all profits by way of dividends, fair value of its identifiable net assets remained at 400,000 on 31st December 2007. The impairment review indicates that D Company's recoverable amount stands at 520 as of that date. The requirement, of course, is that we should establish the carrying amount of D Company's net assets or D Company's assets at the end of the year, as well as the impairment loss. So I'll get back to the same here. For simplification purposes, we are supposed to come up with the carrying amount of the subsidiary D and impairment loss. So let us try to see if we can just run with it. If you're going to find the carrying value of your subsidiary, you need to first of all deal with the net assets, come up with the goodwill, and then if you have got what we call the partial goodwill method, you need to deal with notional goodwill as well, because the goodwill that we're going to come up with here will be restricted to 80%, so our notional goodwill should be the remaining 20% goodwill, so that we can value our company in full. So again, from our rendering, our record, our question, we have our net assets standing at 400,000. I hope that you can see that. And then we have got our, goodwill, partial goodwill standing at, let me just get back the question. We are told we acquired the net assets at 600 and the net assets were standing at 400. They're still standing at 400 because all profits were distributed by way of dividend. So in the old goodwill method, this is what you used to do. You could, subtract your portion of the net assets from the consideration. And of course, our portion is 80% of 400. I think if you do your maths, you will discover that you are really having that amount there. Okay, then on the notional goodwill, I have got 20% divided by 80 multiplied by, yes, we can multiply that by the goodwill at acquisition. Yes, again, not very difficult there to understand. So I do the work, 280,000 multiplied by, in brackets, 20 divided by 80. Okay, so what's the challenge there? There was no equal sign. So let me just put the equal sign. I've got a 70 there. And then all I need to do now is to sum up all the figures there Okay, I hope you can see that is our current value of the sub of D. And what's the recoverable amount? Our recoverable amount of the subsidiary is standing at 520. That is 520, and therefore the loss, impairment loss, is the difference. Yes, it is the difference between the 230. All right, so now this 230 should be allocated, all right, appropriately. And in our allocation, we want to be a little bit careful because remember that goodwill must go first. So goodwill is going to go first. Then we shall remain with, remember that, let me just go to the goodwill. Our goodwill here is standing at that amount there. That is 1280. Then the impairment loss is standing at 230. So what will happen is that parent is going to have to get its share of this particular loss. So Aston's share of the loss standing at 230 multiplied by 80%. What do we have? 230 multiplied by 80%. I'm getting 184. So that the revised is going to make sense here. So our revised goodwill will be, okay, our revised goodwill will be 280,000 less 184. Hope that you can see that. Okay, so put an equal sign, then I less 184. There we go. I've got, alright, what's going on? I think we need to put some kind of brackets here. Oh, that is too much. Okay, let's do it again. 280,000 minus 184,000. I've got 96, so that will be our revised goodwill. Okay, so we have dealt with the two requirements, and I hope that you're getting something here so that you can you know, come up with some solutions. So say the carrying amount and the carrying amount of the goodwill after the recognition of the impairment loss. Okay, so we go now to the next question, which says what does the next question say? Some years ago, Aston acquired 85% of the McClellich company for 800,000. Fair value of McClellich identifiable net assets stood at 700,000. Goodwill was calculated for us already, is recognized using what we call the partial goodwill method. AIM policy is to distribute all profits by way of dividends once again. So our retained earnings, not retained earnings, but net assets still remain at 700,000 at the end. The impairment review indicates that AIM recoverable amount is 660. It is AIM's group policy to value the non-controlling interest using the proportion of net assets. So it's very important for us to just run through this particular question and try to see how we can resolve. Okay, so this is a different question, so I want to have a clean slot here. Let us try to see if we can survive this one. So again, we want to acknowledge there's a dollar sign there. What is the CV of the net assets? Of M, you have got 700. What else do you have? Recognized goodwill. Recognized goodwill is standing at 205. You know, I think if you look at the question, that is obvious. This is the amount that was calculated, and the assets net asset value stands at that amount. Then we roll forward notional goodwill, under the roll forward. We say 205. Yes, we do. Let me just do that. 205 multiplied by how much was the percentage of our interest here? 85. So you say 15 divided by 85. That's how we do the roll forward. So we can get the notional goodwill. Again, you know, I don't think that this should be very difficult. Here I've got 36, 170. So the total value of this particular subsidiary is standing at that much. Now, our recoverable amount is below, so it means that we've got an impairment loss. An impairment loss of how much? If you check your question, you will be able to see that we have a recoverable amount of 660. Again, in this question, you're supposed to find the way we allocate goodwill. Carrying amount of the non-controlling interest in McCulloch. Okay, I wouldn't have, maybe I didn't read that one, but this is what we're supposed to find. The carrying amount of the non-controlling interest of McCulloch. So we started by dealing with the evaluation of the sub. Okay, so we do the same here. All right, so this one is done. Let me just escape this one. This is done. So what is the figure for the recoverable amount? 660. That's what we had there, and I think it's supposed to be a minus. With that there, let's list the amount there that is supposed to, so we can get our figure there. So the loss, the impairment loss is 281,176. Now this figure should be allocated in the right order. Okay, so we shall allocate that 281 first of all to goodwill. That means recognized goodwill as well as notional goodwill. So the recognized goodwill is 205 plus the notional goodwill is 36 176 if I'm not mistaken. So you've got 205 plus 36 176. You have got that. Now notice that you have not exhausted this full impairment loss. Still remaining with some value. So other assets will be allocated with the impairment loss. So let's find the difference here. this minus that figure there. So other assets to be allocated with 40,000. Now the question is not asking us to end at allocation of impairment loss. The question is asking us to find NCI after this particular impairment. So your NCI will be equal to the net assets, all right, the net assets of this particular company stands at 700,000. Then you multiply that by, you less rather, before you multiply, you less a 40,000, that is impairment for other assets, and then you restrict that to 15%, that goes to NCI. So I'm going to just do that in Excel so that we can see what is happening. Okay, so that we can see what is happening. Okay, there we go. Yes, so that's what you have there. Yes, we have got about 99,000. So thanks a lot. We need now to progress to intangible assets. Remember, we're trying to look at all these standards at once and try to see if we can make some. Right, so for our intangible assets, we have got the following questions, and let me go to the STEM again. No, I tend to forget to read the STEM, the requirements rather, because requirements are very important. It says explain how Lambda should treat the above transactions in its group accounts for the year ended 31st March 20X9. You are not required to discuss the goodwill arising on acquisition. So it's explanations, right? And at this stage of your studies, you need to be able to communicate. There are no excuses for failing to communicate. I hope that you have heard that. Lambda is a listed company, prepares its group accounts, and Lambda measures assets using the revaluation model, wherever this is possible under IFRS. During its financial year 20X9, 31st March, of course, they ended in the following transactions. So A says, on 1st October, now notice that the year end is 31st March, but on 1st October, meaning 6 months before the end, Lambda began a project to investigate a more efficient production process. Expenses relating to the project of 2 million were charged in the statement of profit or loss and other comprehensive income. That is for that year, 31st March 20X8, which is outside our focus. Further costs of 1.5 million were incurred in the 3 months period to 30th June 20X, 8. On that date, it became apparent that the project was technically feasible and commercially viable. Further expenditure of 3 million was incurred in the 6 months period from 1st July to 31st December. The new process, which began on 1st January 20X9, was expected to generate costs savings of about 600,000 per annum over a 10-year period commencing on 1st January 20X9. So I want to just make some bit of comments here. So on the date when we attain, commercial viability, we must stop expensing and start capitalizing, because now we have what we call development expenditure. Now, which date is that? Okay, I think it is 1st July. Okay, and I just read on that date, or 30th June, if you may like. On that date, on 30th June, it became apparent that the project would be commercially viable. So we stopped expensing from that date. But with regards to amortization, we can only start amortization when the process begins, that is 1st January. So in our explanations or submissions, these are some of the points that we need to give out, and I thought I just give these ones to you. The treatment of development costs. This is lambda. I hope that I'm not on the other side. Okay, so begin to write from here. Capitalization under lambda should commence upon attaining commercial feasibility from 30th June onwards. All right? Then you make another comment, you say the 3 million incurred from 1st July to 31st December X8 is capitalized. Capitalized amounts should be amortized over a 10-year period, giving a charge of 300,000. Now, how do we know that? Okay, we have to calculate to say, yeah, so 3 million, are you there? So you have got a 3 million, then you multiply that by 3/12. Now 3/12, we are running from 1st January to 31st March. So if you try to use your calculator, if you say the 3 million by 3/12, I'm sure you are getting 75,000. Yes, 75,000. And so the CV will be 3 million minus 75,000, which will be 2,925,000. All right. So that's what you do on the first question. Then on part B, we are told on 1st April 20X8, Lambda acquired a new subsidiary, Omicron. The directors of Lambda carried out a fair value exercise as required by IFRS 3 business combination and concluded that the brand name of Omicron had a fair value of about 10 million and would be likely to generate economic benefits for a 10-year period from 1st April 20X8. Further concluded that the expertise of the employees of Omicron contributed 5 million to the overall value of Omicron. The estimated average remaining service lives of the Omicron employees was 8 years. So you have to advise. I think I've already read the statement. Okay, so let's progress from there. Okay, you write the following. You say the brand name can be capitalized at its fair value of about 10 million. Brand name can be capitalized at its fair value of about 10 million. Amortization over 10 years is going to be 1 million. So you divide 10 million divided by 10. So the asset remember that this acquisition was on 1st April, so we are dealing with full year amortization. Asset CV at the end of the year will be 10 million minus 1, which is 9 million. Now, I want to make a comment on employee expertise, because we are told that they further concluded that the expertise of the employees of Omicron contributed 5 million to the overall value of Omicron. I think the employees' expertise cannot be recognized as an asset, as Lambda has no control over the employees. There's an exception, of course. If footballers are employees of the club, then we have got an exception there, because footballers can be valued. All right, you need to think about that. Okay, so C now. C says on 1st October 20X8, Lambda renewed its license to extract minerals that are needed as part of its production process. Cost of renewal of the license is 200,000. Now 1st October is 6 months away from the reporting date. The license is for 5 years period on 1st October 20X8. There is no active market for this type of license. However, the directors of Lambda estimated that at 31st March 20X9, the fair value less cost to sell the license stood at 175, meaning that we might have an impairment loss here. Further estimated that over the remaining 54 months, if you say 54 divided by, let's say, 12, you're getting about 4.5 years. Month duration, the license will generate net cash flows, present value, net cash flow of Lambda to a present value of about 185. How do we go about that? So initially, the license should be initially recognized at cost for 200,000. Amortization is to be done over 6 months. So you know that's 200,000 divided by 6, no, not 6, but 5 years. Then you multiply that by 6/12 to get your 20,000. So at the date of review or at the reporting date, our CV, the CV for the asset will be 200,000 minus 20. That gives us 180. Now you need to compare that 180 to the new recoverable amount of 175, and you will discover that okay, let's check there. Impairment occurs when the carrying amount is greater than the recoverable amount. The recoverable amount is 185. All right, let's check that one. Is it okay? So the recoverable amount is 185. Yes. So yes, let me just get that one clear. The recoverable amount is the higher of 185 and 175. So 185. The 185 is compared to the 180, and we discover that the recoverable amount is higher than the CV. Therefore, there has been no impairment loss. So I thank you for listening to this recorded lecture. Next time when I deal with this type of session, I'm going to give you final lecture on non-current assets. I want to thank you very much for your attention.